Highliner Foods delivered a massive top and bottom line beat for Q2 2026. Revenue came in at 269.3 million US dollars, up 12.4% year over year, which completely crushed the 253.3 million consensus.
Yeah, and adjusted diluted EPS came in at 44 cents USD. That is a 61.8% beat over the 27.2 cent street estimate. Management maintained a cautiously positive full-year outlook, calling for low single-digit volume growth, a second-half gross margin just shy of 20%, and an improved adjusted EBITDA trajectory.
Oh, and net debt leverage is expected to dip slightly below 3.0x by year-end.
Exactly.
The market reacted constructively to all this. Shares initially popped 3.21% in after-hours trading and followed through in the primary session. They ended up surging 7.53% to close at 15.42 Canadian dollars on heavy volume. Over 146,000 shares, which is nearly 5 times the daily average.
Huge move.
Right, so the headline numbers are spectacular. But, if you are a retail investor looking at your brokerage account right now, you might be wondering what happens next. The mission of our deep dive today is to really reconcile that massive adjusted earnings beat with some serious underlying margin and cash flow pressures that were buried much deeper in the financial report.
Because beneath that initial euphoria of a 61% earnings beat, you find a financial statement that is, honestly, incredibly noisy.
Totally.
It is a classic case of the headlines not telling the whole story.
Yeah.
Like, if you only look at the adjusted metrics, you're missing half the picture. The gap between those adjusted numbers and the reported GAAP numbers, the generally accepted accounting principles that dictate how companies must officially report their finances, it's staggering this quarter.
We definitely need to look at both to understand the true health of the business.
Oh, absolutely.
Okay, let's unpack this immediately because the discrepancy is glaring. We have this huge adjusted EPS beat, but then you look at reported net income, and it actually plunged 40% year over year down to $5.1 million.
Yeah, massive drop.
And gross margins. They contracted by 370 basis points. That's a 3.7% drop, down to 18.6%. So looking at those official unadjusted numbers, is this adjusted beat just a clever accounting trick masking a fundamental deterioration in their core profitability?
Well, to get to the bottom of that, we have to isolate the non-recurring noise. And there is a lot of it. The primary culprit for that massive 3.7% hit to reported gross margin wasn't a sudden inability to sell fish profitably.
Okay, so what was it?
It was a $10.1 million inventory loss due to a structural fire at a third-party warehouse facility.
Wait, a literal fire?
A literal physical event, yeah.
Yeah.
GAAP rules require the company to recognize that massive loss on the books right now because the inventory just burned up.
But management expects to recover that entire amount via insurance by the end of fiscal 2026,
Right, which is exactly why they normalized it out of their adjusted net income. They're telling investors, yes, we took a hit, but we are getting the money back. So don't model this as a permanent flaw in our business.
That makes sense.
But the warehouse fire is really only the beginning. You also have this massive tariff tug-of-war going on in the background, which gets into the mechanics of international trade. During the quarter, Highliner incurred $5.7 million in tariffs related to the International Emergency Economic Powers Act, or IEEPA.
Okay, let's break that down for anyone not living in the weeds of global trade policy. When the government enacts sudden economic sanctions or trade restrictions on specific global regions,
Right.
companies that source raw materials from those regions get hit with massive, unexpected tariffs. They have to pay those fees directly out of pocket just to get their raw seafood into the processing plants, which immediately drives up their cost of sales.
Yeah, but the mechanism of these tariffs also includes an exemption and appeals process. So while they took a $5.7 million hit to their cost of sales this quarter, they simultaneously recognize a $7.9 million tariff recovery from previous periods.
Oh, wow. From where they successfully appealed or qualified for exemptions.
Exactly.
So, if you're reading the official earnings report, you are seeing a warehouse fire dragging margins down, new tariffs dragging margins down, and retroactive tariff refunds pulling margins back up.
It's just a completely lumpy, distorted picture.
It really is. When you strip all of that accounting noise away, the fire, the retroactive recoveries, the new tariffs, what does the actual core profit engine of the business look like?
What's fascinating here is that it looks remarkably strong. And the best way to measure that is through their degree of operating leverage, or DOL. If you run the math on this quarter, Highliner achieved a 1.64 DOL.
Let's put that into plain English. That means for every 1% of revenue growth they bring in the door, they drive a 1.64% expansion in their adjusted EBITDA, which is essentially their cash profit from operations.
Think about how a factory works. You have fixed costs, right?
Hmm.
The rent for the building, the salaries of the plant managers, the maintenance on the machinery.
Yeah, and those costs stay exactly the same whether you process 1,000 pounds of fish or 1 million pounds of fish.
Exactly. Once you sell enough product to cover those fixed costs, every additional dollar of revenue you generate drops almost entirely to the bottom line. That 1.64 DOL metric proves that beneath all the one-off accounting noise, their core factories are actually running highly efficiently.
Because their adjusted EBITDA hit $30.2 million, up over 20%.
Right. They're pushing more volume through their plants, and those incremental revenue dollars are accelerating their profit growth.
So if their profit engine is running that efficiently and margins are expanding behind the scenes, the natural question is, where is all that cash going?
That is the big question.
Because when you look at the balance sheet, it is certainly not sitting in the bank account. Operating cash flow swung aggressively from a $15.6 million inflow at this time last year to a $3.0 million outflow this quarter.
Huge swing.
Meanwhile, their net debt ticked up to $335.8 million.
The cash flow statement is where the fundamental tension of this quarter really lies. They are generating profit, but they are tying up an enormous amount of capital in working capital, specifically inventory.
It's kind of the corporate equivalent of a consumer hoarding non-perishable groceries right before a hurricane hits.
Oh, that is a perfect analogy.
Right. You pull cash out of your savings account to pack the pantry because you know the storm is coming, supply chains are going to freeze, and prices are going to spike.
Yep.
But as an investor looking at a business, you have to ask, is this cash burn a sign of distress? Like maybe they cannot sell the inventory they have? Or is this a calculated tactical maneuver?
Well, management's commentary points directly to a tactical maneuver. They clarified that 2/3 of that inventory build was purely opportunistic procurement.
Meaning what, exactly?
Meaning they're looking at the global seafood market, seeing impending supply shortages, and intentionally front-running expected price spikes. Only 1/3 of the build was due to baseline, unavoidable commodity inflation that's already happening.
Wow. So they are willingly taking a short-term hit to their free cash flow to protect their future cost of goods sold. By locking in the raw material costs today, they're effectively buying an insurance policy against future inflation.
And beyond just the cost, it guarantees availability. This strategic raw material positioning ensures they maintain high fill rates.
So when a major grocery chain places an order, Highliner knows they actually have the fish to put on the truck.
Right. That reliability protects the top-line revenue growth we just talked about. But, and this is a massive consideration for anyone holding the stock, this strategy has a direct, immediate consequence on their leverage.
Yeah, because their ratio of net debt to adjusted EBITDA crept up to 3.6 times this quarter.
Exactly. That is a critical metric.
It means their total debt is now 3.6 times higher than their annual cash profit, and their stated long-term strategic target is 3.0 times. So they are running significantly hotter than they or their lenders really want to be.
And when a company operates that far above its target leverage ratio, it restricts how they can use their capital in the short term. Specifically, it means they cannot safely use their cash to buy back their own shares.
Even though Highliner has an approved normal course issuer bid in place.
Right. Which is just the official regulatory term for a pre-approved plan to buy back stock on the open market, which usually drives the share price up and rewards investors.
But you can't aggressively execute a share buyback program when you're carrying over $335 million in debt and burning through operating cash just to hoard inventory.
No, you can't. The lenders holding that debt expect you to prioritize the balance sheet first. Prudence dictates you pay down the debt before you reward shareholders with buybacks.
You have to ask yourself, though, if the company is tying up all this cash in inventory to ensure product availability and they're facing all this inflation that they eventually have to pass on to the grocery store, are people actually buying the product at those higher prices?
Right.
We really need to examine if the consumer is absorbing this inflation or if they are walking away.
Well, here's where it gets really interesting. The top-line data here is what caught Wall Street completely off guard. Despite aggressive price hikes implemented across the retail portfolio, sales volume actually grew 4.0% to 57 million pounds.
In a highly inflationary environment, when a food company shows volume growth, my immediate reaction is skepticism.
Sure.
You always have to ask if this growth is coming from low-margin bulk contract work, where you're just churning out generic product at break-even prices to keep the factory lights on, or if this is actual sticky brand loyalty from retail consumers who are willingly paying a premium.
It is actually a combination of both.
Yeah.
But the retail branded performance was what really stood out. Yes, some of the volume growth was driven by lower margin USDA contracts and contract manufacturing.
Which provides the baseline volume necessary to keep those factories running efficiently, right?
Yeah,
Which directly fuels that impressive operating leverage we discussed earlier.
exactly. But the real star of the quarter was the volume inelasticity of their premium retail brands.
Volume inelasticity, meaning Highliner raised the price on the box of fish, and the consumer didn't blink.
They didn't blink at all. They didn't trade down to a cheaper generic brand. They just kept putting the premium product in their grocery cart.
Amazing.
The Sea Cuisine brand is the prime example of this phenomenon. They recently launched new value-added items like skillet meals and Guinness-battered fish strips. Management specifically noted that Sea Cuisine retained robust consumer demand in both club stores and traditional grocery channels, even after promotional discounting ended.
That right there is the ultimate test of a brand's pricing power. I mean, anyone can move premium seafood when it's heavily discounted on an end cap promotion.
Right, cool.
But moving full price premium frozen seafood when everyday household budgets are stretched incredibly thin, that shows the consumer perceives real, tangible value in the product.
It highlights a broader psychological shift in consumer behavior right now, I think. People are feeling the pinch of inflation, which means they are dining out less often, but they still want that high-quality experience.
So they are looking to replicate that restaurant-quality seafood meal at home.
Yeah. If you look at a premium frozen skillet meal, it might feel expensive compared to basic frozen fish sticks, but it is incredibly cheap compared to a seafood dinner at a sit-down restaurant for a family of 4. Highliner is successfully capturing that trade-down audience.
And it isn't just their legacy brands doing the heavy lifting either. The integration of the newly acquired Conagra brands, specifically Mrs. Paul's and Vandekamps, is firmly on track.
Those are massive, iconic legacy brands in the U.S. market. Bringing them into the Highliner system adds crucial, high-margin retail synergies.
Oh, like when you can put Mrs. Paul's fish sticks on the same delivery truck going to the same grocery distribution center as your Sea Cuisine fillets.
Exactly. You instantly save on freight and logistics costs. Generating those higher margins on the newly acquired brands is exactly the kind of operational efficiency that justifies the heavy working capital investments and the inventory hoarding we discussed in the cash flow section.
Okay, so what does this all mean? We have a massive earnings beat. We have strong operational leverage, proving the factories are efficient. We have consumers willingly paying up for premium brands. And we have strategic inventory positioning protecting future supply.
Sounds pretty bulletproof.
Right. Yet, despite the 7.5% post-earnings pop, the stock is still trading in the lower half of its 52-week range, bouncing between 13 and 17 Canadian dollars. Furthermore, the consensus analyst rating from Wall Street remains a stubborn hold, with an average price target of just 16.70.
Yeah.
If the operational execution is genuinely this good, what is the sell side so terrified of?
Wall Street analysts are looking past the factories and focusing on the structural, macroeconomic risks that are entirely outside of Highliner's control.
Ah, like the fish themselves.
Exactly. The core bearish thesis comes down to severe global species shortages. We are seeing intense, supply-driven inflation in key commodities like Norwegian cod and Alaskan pink salmon.
Because you can manage your factories perfectly, you can run brilliant marketing campaigns for your premium brands, but you simply cannot control the biology of the ocean or the global fishing quotas.
You really can't. The catch seasons for those specific species have been incredibly poor. Whether it is changes in ocean conditions affecting spawning or strict international fishing councils slashing quotas to prevent overfishing, the raw supply of fish is tightening.
And analysts project that these structural supply constraints and the resulting price spikes for raw fish will cap any meaningful margin recovery until at least the summer of 2027.
So the bears on Wall Street are arguing that while Highliner had a great quarter operationally, their core processing margins will remain structurally compressed by these harsh biological realities for the next 12 to 18 months.
Well, that is a completely valid fear. But there is a massive bullish counterweight to that biological reality, and it is a major upcoming catalyst that wasn't fully baked into this Q2 earnings report.
The post-quarter tariff recovery.
Exactly. After this quarter officially ended, Highliner received a massive $27.9 million IEPA tariff recovery. That is raw cash hitting their balance sheet in Q3.
If we connect this to the bigger picture, think of this upcoming Q3 cash injection like an unexpected massive tax refund hitting your bank account right when your credit cards are maxed out.
Right, it directly solves the leverage overhang we discussed earlier. Injecting nearly $28 million of cash rapidly accelerates the deleveraging process.
It pulls them aggressively back toward that 3.0x net debt to adjusted EBITDA target without forcing them to organically generate all that cash from daily operations.
And once that leverage comes down to a healthy level, the handcuffs come off management's capital allocation strategy. They can finally start executing on that normal course issuer bid.
They can go into the open market and start buying back their own stock.
Exactly.
This upcoming cash influx essentially de-risks the entire balance sheet. It provides a massive cushion against those biological supply chain shocks, and it potentially forces the sell-side analysts to revise their currently conservative models upward.
Because the analysts kept their price targets flat after this Q2 report. But when that Q3 tariff cash actually hits the books and the debt ratio plummets, those cautious hold ratings are going to be very difficult to justify, especially if the retail volume continues to hold up despite higher prices.
Oh, definitely.
So, to quickly summarize the moving parts of this deep dive, Highliner delivered a massive adjusted earnings beat characterized by really impressive volume resilience. They proved they have real pricing power in the retail aisle, maintaining strong consumer demand for premium products even as they raised prices to offset inflation.
Yeah, and they managed to do all of this while navigating one-off inventory losses from a warehouse fire, battling complex international tariffs, and executing strategic cash flow draws to front-run future commodity shortages.
The reported JAP financials were definitely messy, but the underlying operational engine is undeniably humming.
The business is effectively using its sheer scale, its efficient factories, and its premium brand portfolio to build a buffer against external supply chain shocks. The lingering question for Wall Street is simply how long that buffer can hold off the macroeconomic pressure of global fish shortages.
Which leaves you with a critical macroeconomic question to ponder as you look at Highliner, or really any consumer packaged goods company dealing with raw material inflation right now. As Highliner successfully pushes consumers toward premium, value-added products like sea cuisine to escape raw commodity inflation, at what point does the consumer's budget finally break?
Can brand innovation, clever marketing, and perfectly efficient factories permanently shield a company from the harsh biological realities of global species shortages?
Or does basic supply and demand eventually win out?
It really is the ultimate test of brand equity going head-to-head against the unyielding forces of basic economics.
It is absolutely something to keep a close eye on as the back half of 2026 unfolds and those Q3 numbers hit the wire. Make sure you follow the show for our daily earnings coverage, keeping you up to date on all the critical deep dives you need to stay well informed.